Alright, so in this video we wanted to cover the federal tax differences and the different types of compliance obligations for grantor versus non-grantor trusts. So grantor versus non-grantor is relevant because ultimately it determines how is income and expense reported during the tax year. Does it go on the trust tax return, Form 1041? Is it reported on the grantor's income tax return? And then it also creates issues with U.S. gift taxes, right? Gift tax reporting, gift tax exclusions. These are all the moving pieces that we need to be mindful of. So we have just one slide in front of us here. We'll cover grantor versus non-grantor, some examples, and then how the gift tax issue also kind of arises. So grantor trust is also commonly referred to as a revocable trust. And this is a trust that can be revoked or amended by the trust settlor or the grantor, right? So it's a person that forms the trust and then contributes capital to it. Can this be revoked or amended anytime without anyone's consent? Now, the reason this is important is because if a grantor retains control over assets that are put into a trust, any income earned is going to ultimately be reported on the grantor's federal tax return. And the logic here is, well, if you put money into a trust, but you can still take money out, put money in, amend the trust agreement itself, amend who are the beneficiaries, you retain such a level of control over the assets and the arrangement that it's really just yours, right? You haven't actually shifted this into another entity. And so that's why a grantor trust, all the income and expense is still just being reported on the grantor's tax return. So let's look at an example here. We have John has one daughter named Amy, and he decides to set up a revocable living trust, and this is going to name Amy as the beneficiary. John puts in his house, his stock portfolio, he has some rare art, puts that thing in there as well. Now, under the terms of the agreement, John retains such control over the assets that he can withdraw assets at any time. Amongst other things, right? So because John still retains this level of control, under federal tax rules, this is going to be a grantor trust. And that was likely the intent, right? A revocable living trust is very often a grantor trust. So any income earned on the assets are just going to be reported directly on John's Form 1040, as if he never gave them away. So John's going to report the income and he'll pay the tax on the income. Now the trust, because it's a grantor trust and it's not a non-grantor trust, does not need to file a separate trust tax return, right? So no Form 1041 is required. The other element is the transfer of assets into the trust is not a completed gift. So no Form 709 is required to be filed by John. And that's because if he's still the owner of the assets, he hasn't actually given them up, right? So it's only if John contributes assets to an irrevocable trust that's treated as a non-grantor trust, does he have that potential for filing a 709 and potentially reporting any kind of taxable gifts. So what's the next one in line? So the non-grantor trust. Non-grantor trusts, often referred to as irrevocable trusts. These entities are treated as separate tax-paying entities, right? So from the grantor, right? So there was a completed gift there. The trust must file for an EIN, so it needs its own tax ID number. And then the trust has to file a 1041 tax return every year to compute its taxable income and pay any taxes, and then also report any distributions that were made to beneficiaries. So in this fact pattern, a trust pays taxes directly, right? So the trust would file a 1041, pay taxes directly, unless income is distributed to the beneficiaries, in which cases the beneficiaries record income and pay taxes at their level, right? So this is reported on Schedule K1, very similar to a partnership tax return or an S-Corp return where you have K1s that are issued to the owners. For irrevocable trusts that are non-grantor trusts, if you have distributions to beneficiaries, the distribution and the income allocation is reported on a Schedule K1. Okay, so this is also very, very important here, this third bullet point. The terms grantor and non-grantor are used for federal tax purposes because it is possible to have irrevocable trusts that are still treated as grantor trusts for federal tax purposes. Right? So, for example, you could have an irrevocable trust that can't be modified by the grantor, but there's a provision in there that provides for a reversionary interest, where the grantor can still have some kind of beneficial interest in the trust, so they can get assets back. This is one of many different types of provisions that can create this kind of fact pattern here, where you have an irrevocable trust that's still treated as a grantor trust. And so that's why we use, from a tax perspective, we use the terms grantor versus non-grantor rather than revocable versus irrevocable. Okay. So again, very, very important. When we're talking about tax principles, we're looking at grantor versus non-grantor to determine how is income and expense going to be reported. Now, for this fourth bullet point there, assets transferred into a non-grantor trust is generally treated as a completed gift by the grantor to the beneficiaries, right? So if it's a completed gift, the grantor is allowed to exclude up to the annual gift tax exclusion. So 15 grand in 2020, this number changes year to year, goes up normally with inflation. But for 2020 it was 15,000, and that's per year to each donee beneficiary. Now, this is also very, very important here. The gift tax exclusion only applies in cases where there's a gift of a present interest. So it means that if John puts money into the trust, the beneficiary needs to have the option to access the funds and withdraw the money within a prescribed amount of time. Right? And so what this does is it ensures that if the money is put in and there's no present right to access the funds, then it's a gift of a future interest and not a present interest. And if that's the case, John can still put the money in, but he can't file a 709 gift tax return to take an exclusion on the amount that was put in during the current period. So let's look at the example here. John has same fact pattern as above, right? We're just changing the trust agreement. So John's got one daughter, Amy. Now he's setting up an irrevocable non-grantor trust. Amy's still the beneficiary. And then he appoints a local bank as the trustee, right? So John can't be the trustee here. Now John contributes $20,000 in cash, and then under the terms of the agreement, Amy has the option to withdraw the cash within a limited period of time, and this is referred to as the Crummey powers. Right? So the Crummey powers are provisions in the agreement that allow the beneficiary to access the funds within a certain period of time, and what that does is it gives the gift into the trust this deemed present interest classification, right? So now Amy doesn't have to take it, right? She just needs to have the option to be able to take it. So Amy decides that she's going to let the option lapse, so the funds are going to remain in the trust. The trust files a 1041 for the year to report any income or loss or expenses. And then John is able to file a 709 gift tax return to report the $20,000 transfer, and he can claim the $15,000 annual exclusion. Okay. Now, if the Crummey powers weren't in there, then John couldn't file a 709 to claim the gift tax exclusion, right? Because you cannot claim the exclusion. It's not a completed gift. You can't claim the exclusion unless it's a gift of a present interest, right? So very, very important here. Now, obviously, what's going on behind the scenes here is John has talked to his daughter and said, hey, look, I've set up a trust arrangement. This is the mechanics of it. You're going to get this option, but what I really want you to do is just ignore it. So you let the option lapse. The money stays in there. I get a exclusion in the current year for the cash I put in there, and so it helps lower my taxable estate. And now we have money that's growing in this trust that's no longer part of my estate. It's going to go to you in the future, and it works out best for all of us. Yeah. Now, that's again, those are conversations that are happening behind the scenes. Obviously, that cannot be written out into the trust agreement. The IRS would have a real problem with that. So, yeah, again, very, very careful to look at the precise language that is used in the trust agreements. What are the terms? Because it really does drive a lot of moving pieces here, right? How is income ultimately reported? And subject to tax, and then also how does it drive the gift tax and estate tax implications for the grantor or settlor of the trust. So I hope that was helpful, helped clarify some things. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.